Hey everybody, welcome back to the Investing Channel. My name is Ryan, and in today's video I want to talk to you guys about the return on investment and kind of what all encompasses all of that. But before I get started, please, if you are into investing in what form or fashion, stocks, bonds, real estate, whatever, please look over here on the right side of the screen and hit the subscribe button now. And also when that bell pops up, smack it with your mouse so that you'll be notified when I come up with more videos on investing. And now let's talk about what is your total return on an investment. The first thing I want to talk about is total return. It's basically what is the total amount you've made on your return on investment. And to do this, you need to calculate a few things. You need to calculate how much you initially invested, and then you also got to take into account a few other components like interest, dividends, appreciation or depreciation. So if you've ever put money just into a general bank account that pays you interest, you know that the amount of interest that you're getting is very small. Okay, so now while the bank is paying you a small amount of interest, what they're doing is they're taking your money along with other people's money and they're lending that out to other people, to other organizations, and they're charging them a higher level of interest, a higher amount of interest, and that amount is called a yield. So rather than basically giving your money to the bank and letting them earn a large percent of interest and only paying you a small amount of interest, is you can lend your money to a company. And this is what is referred to as what happens when you buy a bond. Now, a bond is something that a corporation is going to issue, and this is also going to pay you interest. Now, a bond is going to be very similar to a stock in that they both fluctuate in value right after they've been issued. Now, when you invest in a company, you're hoping that the stock is basically going to go up, right? That's called appreciation. But sometimes, as you all know, a stock can go down in value, and that's called depreciation. Now, stocks can also pay dividends, which is the company sharing some of its profits to you as a shareholder. Now, some of the companies, even though they might be small or maybe that they may be making a lot of money, they can choose whether or not they want to pay dividends to their shareholders. But sometimes companies don't do that. They want to take all that money, they want to reinvest it back into the company just to help keep it growing and growing and growing. And the other thing is that some companies, even though they are in the business of making money, initially some of those companies lose money in the beginning and there's no dividends to be paid out. So one of the things you want to think about is that when you're calculating your return on investment, you also got to take into account dividends. Are they being paid out or are they not being paid out? Now keep in mind there are different types of investments. There's basically what's called tangible investments, and there's also intangible investments. So some examples of a tangible investment might be stocks, real estate, or even maybe a small business. Now in comparing a tangible investment versus an intangible investment, more often than not, the tangible is more popular. And why is that? That's because people want to see their investments grow. They want something that they might be able to physically touch. They can see it with their own eyes and they can watch it grow. It's more exciting, right? But if you get a intangible investment like a managed mutual fund, that's just kind of off in the distance. It's something that you don't really watch. It's something you don't really see. It's kind of just out there. And in that aspect, a tangible is going to be very more popular with most people. Okay, the other important thing, guys, is that you need to be aware of is that you don't want to let your ego get involved when you're investing. And the reason is because I know that even for myself, I want to understand different aspects of investing. And oftentimes I know I trust myself more than other people, and I want to basically take my investments and I want to learn and I want to put my money where I want it to go. But that's good and that's great because you're learning, but it's also could be negative because I got to trust and I got to know that there are people out there that have been doing this a lot longer than me, know a lot more about investing than myself, and I've got to be able to trust in them. They can move a lot faster than me in making decisions and suggestions, whereas for me, I've got to take the time out of my day to learn different concepts, different ways of investing, and that for me, that could be a downfall. I'm basically letting my ego get ahead of me when I should have some trust in some people that are the professionals that have been doing it as a full-time career and handling lots of other people's money and investments. All right, and for some of you guys out there that want to be more hands-on and you're like, you know what, I don't want to just kind of put my money into an account somewhere and let it just kind of sit and grow gradually. Some of you guys want to be more hands-on like myself. And what I'd recommend for you guys to do is maybe look more at real estate investing. And the reason is because real estate's fun, it's exciting. You guys can make a quick profit very quickly. I turned $5,000 into $10,000 very quickly on a land deal. And if you haven't seen my other video on that, please go check it out. But for real estate, you can go out, you can see the property, you can walk the corners, you can walk the land, you can walk the house, you can look up, you can look down, you can look everywhere within the house, see what's going on, but you still have to rely on the advice of somebody else. You have to rely on the advice of an appraiser of what the property is actually worth. You need to hire a home inspector to come in and analyze everything about the house and give you a home inspection report so that you can make a well-informed decision before you invest in real estate. So that might be something that you guys could look into if you want to be more hands-on. So I know I'm getting a little bit off base here, but let's get back to savings and money market return on investments. So one thing that you want to do is, as you're making money, you want to basically take a certain percentage of that money and you want to put it somewhere. Put it somewhere safe, don't touch it, and just let that keep compiling. And the reason why you want to do that is because you want to have a little bit of a nest egg in case you see an investment opportunity come across your path that you want to invest in. I mean, how many times have you seen an investment opportunity come across your desk and you don't have any money set aside? You see all your friends going out, they're investing, they're buying properties, they're doing whatever, they're buying Bitcoin when it was low, whatever it is, and you're like, oh shit, I didn't have any money set aside. Now, you know that you could basically put that money easily into a savings account at your local bank branch, your Bank of America, Wells Fargo, Chase Bank, whatever bank you bank at. But you know that, like we said in the beginning of the video, you're only getting a small percentage of interest. And a far better investment opportunity for you guys is to not put that money in that small paying, low interest account. And rather than putting it in your savings account, I'd recommend putting it in a money market mutual fund account. Now, these are the safest types of mutual funds that are out there. But the one thing that you got to be aware of is that the money market mutual fund account is going to pay you a higher yield than what a savings account would. And one of the things that people like is that with a money market mutual fund is they're going to be telling you exactly how much it's going to cost you to service your money, unlike a traditional bank savings account. And for those of you that are in a higher tax bracket, there are some mutual fund accounts out there that are tax-free. And if you don't need immediate access to your funds, you could basically look at investing into a T-bill or a CD. Now, a T-bill is known as a treasury bill, and a CD is a certificate of a deposit. And basically, you have a term of a few options: 3 months, 6 months, or 12 months. So if you don't need access to your money right away, you could invest in a CD or a T-bill, and you're basically just putting your money for a set amount of time, 3 months, 6 months, or 12 months, and then you can get access to it. But the point is that you're going to make more interest on that than you are with a traditional savings account. And one of the things you guys need to be aware of is if you guys invest in a CD or a T-bill, is that you're basically going to pay a penalty if you need to get access to that money before that term limit is up, the 3 months, 6 months, or 12 months. So if you put that money in there for 12 months and then 8 months out, you see an investment opportunity and you're like, oh, I need that money. I need that money to invest in that. Then what you're going to have to do is you're going to have to pay a penalty to get access to your money. So you just need to be aware of that, okay? Now let's spend a moment talking about bond returns. Not James Bond, but bond returns. Now when you buy a bond, you're lending your money for a certain period of time to the issuer of that bond. And that issuer of that bond could be either the government or it could be a corporation. And the great thing about buying bonds is that you're earning more interest than you would typically if you just put your money into a savings account or you put it into a money market account. Now, even though buying a bond is great because you're earning a higher level of interest, that's because there's more risk involved. And the reason why there's more risk involved is because you're basically lending your money to a corporation. Now, I know I mentioned you're lending it to either the federal government or you're lending it to a corporation. But in terms of a corporation, there's more risk involved because it's a business entity. And if that business doesn't go well, if it closes its doors, then that bond goes bye-bye, bye-bye bond. It's gone. You might lose all of it or you could just lose some of it. But there's more risk involved, and that's why you're getting paid the big bucks, the bigger bucks. So you understand what I'm saying here, right? Now, in terms of buying a bond, there's basically long-term bonds and there's short-term bonds. If you invest in a short-term bond, you make less interest than you would on a long-term bond. So just keep those in mind when you're looking at bonds. There's long-term and there's short-term. And if you can keep your money, if you can buy that bond and keep your money out there longer, you're gonna earn more interest on it. Okay, so let's now talk about the next topic, and that's called stock returns. Now, with regards to stock returns, there's two different types of people out there. There are people out there that like to buy a stock and they like to sit and they hold it. They might hold it for a year, they might hold it for 5 years, for 10 years, for 20 years. But basically the idea here is that they're buying it and they're holding it. And there's the other type of people, the other people that get all excited and they hear about the next big business, the next big opportunity, and they're buying the stock and they're selling it, and they're buying and they're selling it, and they're looking for a quick profit. Now, when you compare the two techniques, more often than not, the one that sits and holds for a longer period of time is going to do better than somebody that is always buying and selling and buying and selling and buying and selling. And the reason is because if you're buying and selling and you're buying and selling all the time, there's more opportunity there to lose. So while you might make a quick hit here and there, in the long game of things, sitting and holding is the best option for you if you have the time, if you're younger in your life. Now, the other thing you guys got to think about is that some of you out there might be wanting to go out and just say, you know what, I'm just going to go after the stocks that are like just shooting upward. That's the only ones I go after because I know I'm going to make a lot of money. Well, let's think about this. Let's say it's shooting upward and you're looking for those stocks. Some people are going to get in early. They're going to buy down here and then they're going to be able to earn all the way while it's going up. Whereas some other people might come in and they might buy right here. They might buy right at the peak, and what happens when you go over a peak? It starts to go down. So you could buy at the peak, it could start to go down, you end up losing money. So basically, if you go out and you look for stocks that have kind of a level set of growth, a solid company with a solid product and a solid history, but still, a gradually upward trending growth pattern, if it's for a long term, you're going to do better that way. You want to go with solid companies that have been around a long time, that are well known, and that people constantly have trust in them, that they're going to provide great products and great service. And if you do that, you will do a lot better and less chance of somebody that's going to go after only those that are rising quickly. Okay? So now let's talk about stocks versus inflation. Now, ever since the early 1800s, stocks have been growing at a rate higher than the rate of inflation. So the great thing about that is that if you invest in stocks, if you invest in certain things like that, you can grow your money faster than what inflation would be. Now, we all know that the cost of goods, the cost of services are always going to keep going up. But if you invest in stocks, then your income should be able to rise at a level higher and faster than what typical inflation would be going at. Now, for some of you out there that like to diversify, let's say some of you are investing in U.S. stocks and you also like to invest in other stocks from around the world. Now, the thing you got to be aware of is that if you like to do that, if you're thinking about doing that, you got to know that when the price of the dollar, when the value of the dollar goes higher, the value of the dollars in other countries oftentimes will go lower. So while one's going up, the other one's going down. So just be aware of that your investments internationally might be going down if the value of the US dollar is shooting up. Okay, so let's talk about the next section, and that is real estate returns. Now let's talk about real estate investing, guys. So for those of you guys that are interested in investing in real estate, let's go back a few years, back to around 2007. That's when the market tanked, when the whole real estate economy dropped. And just prior to that, a couple of years to that, everyone was given a loan. You had stated income loans where basically you just say, I make $300,000, and the bank would go, here you go, here's a loan. And they give you a loan on a house that you couldn't afford. You couldn't afford the payments on it. And so all these people were buying these houses. They were buying second, third homes, investment properties, flipping homes, wholesaling homes. The real estate economy was just going nuts. And when the economy dropped, when the real estate market tanked, everyone was losing properties. Now you want to think about this. If that happened to me, where do I want my investment property to be? Because obviously, let's say you have 10 investment properties that you're holding on to and you're renting, and the economy changes and the real estate market drops, and all of a sudden now you can't afford these homes. You're going to start to lose some of them, right? And you're going to try to keep what you can. But you want to buy in an area that the economy will jump back faster. And think about this. Back when that happened, I lived in Arizona, and Phoenix market, Scottsdale market, the whole area of Maricopa County and other areas around Arizona, it just took a long time to get back. They got hit really hard. And even years after other areas like California had started to rebound, the Arizona market was still dropping. And once the residential aspect of it continued to go through and started to slow down, then the commercial phase started to slow down. And a lot of the builders out there, the home builders, they stopped buying properties on the fringes of the county, and everything just went to a halt. and you drive through the town and it looked almost like a ghost town. A lot of businesses were shut down. But in California, hey, everything's going good. Businesses are flourishing, people's money on their investments are starting to rise, home values are going up. So if you're going to go out and you're going to invest in real estate, you need to think about where you're going to be buying these properties, and you want to buy in an area, in a city or a location that the rebounding is going to happen a lot faster, so that if you have to hold on to some of these properties during that hard time, you're going to be able to, because there's people that want to live in that area. There's people that you could rent to. Even if you're renting for a little bit less than market value, you're getting money coming in to help you on those monthly mortgage payments. So you want to buy in an area that has high demand, okay? So just think about that. Now, the next section I want to talk about is small business returns. And if any of you guys want to start a small business, here's some things to think about. Some of you think, oh, I come up with really cool ideas. I want to start my own business because, it's neat. I'm starting it from scratch. I'm a one-person shop and I'm building it. It's growing and it just sounds cool, right? It sounds like you'd love to go out there and tell that story. I started this business with $1,000 and I grew it into a multi-million-dollar business. Sounds great, right? Well, that's really hard to do. But you also can think that there are people out there that have already started a business, already have an existing book of customers, and for whatever reason, whether it's a divorce, whether it's a death, whatever it is, they have a business that they're trying to sell. And you can go to a business broker and you can basically tell them, hey, I'm looking to get into a business. Can you give me some options of what I can get into? And you can buy a business that's already up and running and ready to go. And then you can just go in there and put your tweak on it and start to ramp it up and do better than what the previous guy did. All you have to do is look at what went wrong or what techniques the previous owner did and see if you could improve that. And if you can improve that and the product's good enough and the service is good enough, then that product should be able to continue to grow and that business grow with you. And you're probably thinking, well, I do want to start a small business. I do have a drive and I think I could make it work, but I just don't know what business to get into. I mean, what businesses out there make money? What can I do? Well, you could basically look around your neighborhood and see what businesses seem like they're flourishing, or you could go and you could look at the Forbes magazine. Go over to your local grocery store, Safeway, whatever it is, Albertsons, and yearly Forbes puts out the richest people of the world. And you can look in there and you can see all the people that are doing really good at business, and you can read their history and you can see what they did and how they got started. And that might give you some indication as to what kind of business you guys can get out there and get running. Now let's look at the other aspect of a small business, is that you don't have to own and operate a small business to do well in life. You could invest your money in a small business. Now, if you set aside a little bit of money and you're looking at maybe doing that, you've already got a job and you don't have the time to start a whole business from scratch and you'd rather just take your money and invest in somebody else's small business, you could do that. And basically what you do is you reach out to a venture capitalist. And there's lots of smart venture capitalists out there. All they do is they go out and they analyze new and upcoming businesses that are up and running, and they put their money into those businesses for a return on investment. And you could basically pool your money with theirs. You'll have to speak out with them, reach out to them and talk with them and see what their options are and see what you're willing to do. You might have to put together some kind of partnership agreement whereby if there's any income to be made, that you guys share in the profits accordingly depending upon how much money is put in. But that's something that you guys can look at. Okay, so if any of you guys are thinking about talking to a venture capitalist, then you need to be aware of this and just be aware of it, okay? So a venture capitalist is also called the general partner. Now, the general partner, what they do is when the profits come in, if you got 100% of whatever the profits are, the venture capitalist will typically, they'll cut off 20% for themselves. Right away, they'll just chip it off. They'll take 20% for themselves, and they're also going to take probably a management fee of anywhere between 2 to 3% for handling everything. And whatever is left, roughly 77%, that gets distributed among the rest of the partners. So that's something that you need to be aware of. And when you compare investing in a small business with a venture capitalist versus just going out and buying stocks and doing that type of investment for the kind of the same period of time, you're going to find that they're both going to be almost even with regards to the amount of profits that you could make. So it's not always the case, but more often than not, it's going to be very roughly similar. So you might want to look at just either investing in stocks or talking to a venture capitalist, there's probably less risk at investing in stocks than dealing with a dot-com startup, okay? Because we know that there's been a lot of dot-com startups out there that haven't done well, and they were supposed to be the next biggest, latest and greatest thing, but they weren't. So these are just some things, tips and tricks that you guys need to think about as you're wondering, where do I put my money? So you're probably thinking right now, Ryan, well, what should I do? Are you saying I should go with a venture capitalist and invest in a small business? Or should I just put my money into stocks? Well, it's really up to you. And here's one thing that you want to think about if you're choosing to go back to investing in stocks, is that who should I invest with? Should I invest in a large company, in one of the huge, monster companies that are out there like Coke or IBM? Or should I go with one of the smaller ones, one of the less known ones? Well, here's something that you need to be aware of, is that typically, on average, the smaller stocks for the smaller companies provide a little bit of a higher yield than the larger companies. But here's the other thing you need to think about, is the large companies have been around a lot longer. They're a lot more stable. They have a lot more cash. They have a lot more customers. They have a lot more history. So these are just some of the things you need to think about. I really don't make any recommendations other than just kind of giving you guys the facts, things to think about when you guys are investing. So that's just something you guys want to be aware of. So where do I put my money? Well, I put it in a couple places. Some stocks. Also, I like real estate investing. I used to invest in real estate land years ago, and I did very well with it at times. And then when the real estate market tanked back in 2007, a lot of the builders in the outer areas of the counties where I was investing, they stopped moving in that direction. They stopped buying land because nothing was moving, nothing was happening. And so when they did that, basically the values of the land started to drop, and now I'm just sitting on it and I'm waiting for the values to go back up, and all I have to do every year is just pay my annual taxes to keep it. So I've got some land out in some areas that I'm just kind of waiting for the market to turn and head in that direction and some growth to increase. So I'm just keeping that land going. But for what I would probably do right now is I would invest in flipping houses. I would go out and I'd try to find properties that I could wholesale, that I could buy cheap, and then I could put renters in there, or I could buy cheap and I would flip it. You want to be able to buy property at like 65, 70 cents on the dollar. That gives you enough play to be able to have enough money for improvements, getting it back into a sellable condition, so that you could quickly flip the property. So that's just something that you might want to think about. You might want to also learn about wholesaling properties. You've probably seen more ads on TV, and when you drive down the street next to a stop sign, you're seeing signs that say, "We buy homes for cash," or "I'll teach you wholesaling." So you might want to look into that aspect. But obviously, if you're going to go out and you're going to buy investment property, you need to have money set aside to be able to do that, and you want to have all your costs involved, or costs known. So if you go out and you find a property, you want to be an expert at being able to walk into a home and go, okay, that's going to run me $15,000. That's going to run me $2,000. That's going to run me $1,000. You need to be able to quickly have some kind of spreadsheet, some kind of Excel sheet that you can, when you go through a house, you can just start check marking stuff off. What's the cost to be able to replace the item? What's the cost to be able to have it repaired? Have somebody come in, like an electrician come in and check all the outlets and everything. You need to have all that so you can quickly, before you go out and make an offer on a property, you know exactly what your costs are. And then you need to also have an emergency fund, because as we all know, if you get into a property that there's something that is hidden that you didn't see, then you got to prepare for that and have that budgeted in your budget to be able to allocate for that. Okay, so that's it for this video, guys. I'm going to be coming out with more videos. Please, if you like the video, look down below in the center there, hit the big thumbs up. It helps me with the YouTube algorithm. And then also, look over here on the right side of the screen, hit that subscribe button if you haven't already. And then when that notification bell pops up, punch it with your mouse so that you're notified when I come up with more videos about investing, whether it's stocks, bonds, mutual funds, real estate, whatever it is. Thank you guys for watching, and I look forward to seeing you guys on the next video. Bye-bye.